Chart of the Week with Redmayne Bentley.
You're listening to financialradio.co.uk. My name's Giles McMullen, chatting to Bill Rook from Redmayne Bentley. Bill, we've got 4 charts to look at today. We're going to start with the FTSE 250.
Yeah, this 250 is on the verge of something happening there. 250, the shaded area is the difference between the 5 and the 20-day moving average. And I said in a couple of interviews before that this is the indicator, that's the emergency indicator when things are out the window. What do you actually do? How do you actually plot a trend? Is the growth, is the earnings, do we look for earnings, do we look for multiples? What do we actually do in this market condition? And I think from technical analysis position, we'd look for 5 and 20. As we looked before on the various worldwide indices, or certainly American indices. Yep. This has worked quite well. And I think this works very well too here. I mean, we're looking here, the wider the difference between that, the more stretched the indicators are, and how also shows how far the market's fallen.
Now,
what I've done here is
Well, I was going to say, I mean, this index has been really hit badly. I mean, if we just look back to the chart that you've sent us that begins in September 2007.
That's right.
It was 11 odd thousand, and it's been down as low as 5, just over 5.5. So I mean, it's down 50%.
Oh yeah, that's right. And this is the full impact of the credit crunch and recessionary influences. Are they priced in or not? And this is the dilemma for investors, really.
That was the question I was going to ask. You sound bullish on this chart so far in what you're saying.
Well, I'm bullish until I'm not.
I know that's the case. But we're sort of heading into, it's generally accepted, what is going to be recession. The only sort of question mark is how deep that recession is going to be. Do you think it looks like that's all been sort of discounted into the price? Well,
I was just looking at some broker notes on forecasts of growth in China, and some people have come out with on one broker's research that suggests 5 to 6. Now HSBC came growth next year. HSBC came out today with some figures suggesting that the Chinese growth might be 8 to 9. So there's some discrepancy about what growth we're actually having there. So this will have an impact. So it's a case of how much stimulation that the governments are going to give their economies, and how much the impact will come through, filter through to the market. I mean, this is sort of it's an ands and frying pans. This is the problem. This is why I think technical analysis is very, very useful here. We're in point of uncertainty. Where do we go with this? And as seen on the previous talks of the recessionary impacts, the 5 and 20 I think has worked quite well, and I would stick with this one. And I would think that 250 is going to find its way to 7,500, and then possibly to 9,000 in the next 3 to 6, 9 months or something like that. I mean, I would think that's like, unless it doesn't. I mean, this is the whole thing. Is that's what I'm looking for on the upside. When the crossover comes with the 5 and 20, then it gives you a point of where you're going, because when it breaks down again, then you possibly could go short.
Okay.
The longer term indicators, at the top there, suggest that the difference between the 50 and the 200, and the MACD weekly suggests that the trend is certainly on the downside.
All right. Well, one to watch, Bill. I mean, you're predicting so far. I mean, things can change, obviously, but there's a potential for 1,000 points of upside in the not too distant future, which would be an amazing trade if you pulled that off. Let's have a look at the next one that you sent us, which is the FTSE Cross.
Yeah, the FTSE Cross. This is again. Well, this is in advance. This has moved in advance of the 250. And I think that's right in calling the bottom. I called the bottom about 37.11 2 weeks ago. I thought that was about it, and that's not only 1% up from there, which is quite nice so far. And it's brought over a little bit, and it's finding its way. Interestingly, the last drop wasn't as low as the previous low point, so it's the first step for the market to take. If it had gone below the 4,000 level, then I think it'd been very bearish. But the 5 has crossed the 20, hence we've got a bit of a green copy, a green blur on the bottom there. I like the colour scheme here. Basically, the moving averages will be a bit dull just without that. So this is the colouring scheme I favour, just for graphics purposes. It looks quite good. Above that, the 50 and the 200. Yeah, we're deeply, as you pointed out before, in bearish territory. And the horizontal and as mirrored by the MACD weekly, which is also negative. But the horizontal line or vertical line, going through on the right hand side on the 3rd or 4th November, I think it's The 4th you'd have bought 3rd November crossover was where the 5 crossed the 20.
So when a new client comes to you, or an existing client, and says, what do you reckon, Bill? Should we be putting money into the market at the moment? You're telling them to put some in. What sort of stance are you taking?
I would take the stance of looking at the last slide, and that will tell you seasonality, what the market looks like.
Okay.
Which we haven't got there yet. Seasonally, the market's good.
Okay, well, we'll come to that shortly. Before we do, we're going to have a look at the S&P 500. So it's another index that you want to have a look at. And again, it's another index that's been hit quite badly in recent times, although more recently it's bounced a bit. What do you make of it now?
Well, this is SPDR, and this is obviously an ETF of the S&P. And we've looked at this numerous times. I looked at it last week, but I've gone zoom in here and just had a look at the last the week or so. We can see that I think there's a head and shoulders, the inverted head and shoulders bottom brewing in there. Now, whatever that means is that we've got a 90 level or 900 support level on the S&P. So if that holds that level, then the final shoulder. I suppose the right-hand shoulder is in place, and we could expect a flip up from here, maybe to 100, I suppose 15 from there, 115 or 1150 on the S&P. Also on there, I put the VIX on here. Again, the VIX, someone said the wicked VIX is dead. The volatility is brewing off again, and then this is very good, as we said last week. Soros is one of the points he looks for is volatility dropping off, and this is what's happening here. And I've also put an inverse Fisher on here, which is a sort of a normalized RSI. To give you an example, this is the first time this is turning positive in a while, and it would have kept you out or would have kept you away from this until fairly recently. So this is, the Omens are looking for a recovery here. That's what I'm saying, a recovery on the markets, and this will be highlighted by the last one.
Okay, Bill, and as you say, it's going to be highlighted by the last one. Let's take a look at that last one, because this is a very interesting one. Not that the others aren't; they're interesting too. But this is quite a fascinating way of looking at it. So just talk us through this one. What have we got here?
Well, this is the Dow since 1970. We've got basically 38 years of Dow, and what we've done here is say, okay, what would I get if I just traded the Dow from November the 1st till April 30th, and the other converse to that one is what happens if I bought the Dow from May the 1st and sold on the 30th of October. And now May to October over that period would yield minus 21% on that period. Now, if you took the November to April period, you'd actually be yielding 294%, which equates to about 7.7% per annum, and that includes costs in and costs out. But funny enough, it's only since 1970. Beforehand, the correlation between the seasons isn't as strong as it is now. There isn't a massive division. Beforehand, it would have been about 0.8% in that in the earlier period. So this period, taken from 1970 onwards, there is certainly more money to be made from the autumn, spring months than there are in the summer and late spring, late and summer months. So it's a fascinating bit of information there. So you said earlier, what would I be doing now? I'd be looking to buy this market, I think, selectively. And as and when certain sectors certainly come to light, I think the key to this will probably be the emerging markets, and we'd like to see some oil price turn up as well. So the commodities turning up, dollar weakness, to suggest the money isn't seeking to just sort of safe sanctuary, and that goes with that. We want yen weakness as well, and we're going to see some more rate cuts, possibly, which would support the 250, and general fiscal stimulus. I think we're ready for a bit of a run here. I'm fairly bullish until we're not, really.
And could you take that approach further? You're saying, had you just implemented buying on the 1st of November and selling on the 30th of April, or closing your position rather on the 30th of April, you'd have made 7.7% per annum for the last 30 years. What would happen if you shorted on the 1st of May and closed that short position on the 31st of October?
Well, this is interesting, isn't it? That's interesting. I actually think, you'd be up on that. I suppose but with that, you'd refine that and actually look at like a moving average crossover system on the downside, which you'd only use during those months of May to October. So you only allow yourself to trade there, not become deluded thinking, well, this is easy, I'll start trading into the autumn months. So you don't do that. So that is certainly a possibility. And I was talking to colleagues about that earlier. This is something you just have to remind yourself that this is, or oneself, that this is certainly viable. Trading with the seasonality in mind, I think, is certainly a winner.
Bill Rook from Redmayne Bentley, always a pleasure talking to you. Thank you very much for sharing your views with us this week.
Pleasure, Charles.
Chart of the Week with Redmayne Bentley.